Good morning, traders. Today is December 18th, Sunday. I thought I would try to put together some special updates for you guys as we head into the end of the week. This is a weekly ES chart, and what I want to point out today, actually, before we get into this chart, remember, I've got a lot of analysis going on here related to flags and formations and apexes. But before we get into this chart, what I want to do is highlight some of these custom index charts and what we are going to be looking at over the next couple of weeks. So this is the custom US to global market index. And you can already see the support level here in the blue area and in the red area here that I had indicated from back in COVID. I had expected the US markets to try to find support above the COVID high, whereas the global markets were going to try to find support down near these COVID lows. You can see what happened recently. The global markets broke down into a very deep contraction, whereas the US markets held up. We have seen some alignment recently to the upside over here. US markets were weaker last couple of weeks, whereas the global markets show a little dip right here. We're kind of flagging out into the end of the year, back here near this support level. I really do believe that the markets are searching for a new trend, and I'm going to show this to you here on the next chart, which is right here. The custom volatility index is a measure of price activity in a range. Now, typically, anything above 7.8 is considered moderately bullish. This is 8.82 right here, so this would be the 8 level right here. You can see anything above this level here, 8 is moderately bullish. Anything below that level is moderately bearish. When we get below this 6 level right here, this gets into extreme downward trending. This is where you start to see major collapses in the market, like COVID or 2008, 9. This is where you're going to see some big pullbacks. Now, normally in an uptrend, especially when it's struggling, like at this time, June, July, August, September, October, of 2020. This was a bullish trend, but we still had some pullbacks. We hadn't actually moved back into very strong momentum yet. We started to get into stronger momentum back into here, November, December 2020, where we started to see a real appreciation phase, and this was the big speculative phase. Now I will preface this that these 14, 15, 16 levels up here were unprecedented. Prior to this, we would get into 11s and 12s and maybe 13s, 14s, which would be a topping area. You can see this red box. This is really a topping area up here. So we got into a little topping area about 2 weeks ago, 3 weeks ago, and we have been in this downward channel. You can see this downward pitchfork sloping downward, as well as this upward pitchfork back over here. So we have an upper channel from 2000. Basically 9, 10, 11, the bottom, moving forward across here. And then we have a downward channel from this 2020 high, which was COVID, moving downward. Now, what we've done in this downward channel here is we've now moved to the upper extremes, tested these upper extremes, failed, come back down here, and we've moved into this sideways flagging formation. The end of the week, last week, ended in this tiny little white candle right here. And I see a flagging formation setting up. I believe the markets are in a mode of transitioning into a reflation trade, which is very similar to what I'm calling the 2003 to 2005 reflation trade, where the U.S. markets had deflated after a speculative bubble and the dot-com bubble and the 9/11 crisis. We had those two things happen over about a 16-month period, and we had a big deflation trade in 2000, 2001, 2002, eventually bottoming out and starting to reflate back upward in 2003, 4, 5. At that time, gold and silver set up a very solid bottom and started to trend higher, and we moved into a solid reflation trade up until 2007, 8, 9, when the global financial crisis hit. I believe we're in that same type of a setup right now. I believe we are transitioning away from this downward sloping trend after COVID. Think of this as essentially a disruption in the normal market. Had we not had COVID, where would we have been? We probably would have been somewhere in this upper channel, back up into these areas. This was where the 2021 peak hit. And now we've gone into this downward cycle, excuse me, which it looks like it is abating, looks like it is stalling out. And I believe we're going to move up to the upside in early 2021, move back up into this 11, 12, 13 area, which will put us back into topping phases, and move into this channel, this 9, 10, 11, 12 area for many, many months going forward, I believe. Excuse me, a little phlegm in my throat. But long and short of it is, let me show you some other indicators why. Now, we still have risk. Obviously, global financial markets, credit risk, the Fed raising rates. We could see another attempt back down into these areas. And these vertical lines here are Fibonacci time cycles, which indicates that we were setting up for a major inflection point right here between April, May, June of 2021 and October or so of 2021. Then we had a major end event here. This is an end of a prior cycle, transitioning to a new cycle. Now we're in this area right here, which is where this new bottom is set up, where we have an inflection point, a potential change of trend, which could move us into an upward trend here, eventually transitioning into a new longer-term cycle trend. Now, let me show you why I think we're moving into this direction. So, two things here on this chart. This is the fear index and the leading market index. The leading market index is this bottom chart here that looks like it's cycling upward, whereas this is the S&P, the SPY, and this is my custom fear index. Custom fear indexes move back down into moderate fear. Okay, so we do have some moderate level of fear here, which means we should not be attempting to be overly aggressive. We do not want to be overly aggressive with our trading right now. We are seeing some support in the markets, but we're seeing moderate levels of fear. We could begin to take small token positions in certain assets right now that we believe will potentially move higher over the next 6, 10, 12 plus months. That's what this lower fear level tells us, is we're back into being able to start taking some initial token, smaller positions, meaning please don't be aggressive. This is not the time to be betting the farm on anything. We are transitioning, and we may move into a very solid trend in 2023. But what's interesting about this leading index is that it's taken out these highs from back here in August. Whereas back here on the SPY, we still have not taken out these highs. So if you follow the logic here, we've gotten into much lower fear factors. We've actually established a new high here, which is telling us that the market is attempting to appreciate. You can see here after COVID, we don't have a whole lot of unique highs. We have one high back over here, and we have another high back here and here. Once we got into this level of getting higher highs here, we moved into a higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, high, and then eventually it peaked. You can see how this leading index peaked in May or June over here, whereas the SPY continued to trend higher. You can also see that the fear level started to increase at this point, and we started to get to moderate levels of fear, which is where we want to start to pull away from the market. This leading index began to trend lower, lower low, lower high, 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 all the way down to this bottom. Now we're getting higher high, higher low, higher high, higher low. So we're starting to move into this uptrend, which means we're reflating. We're moving back to the upside here. Is this the end of the trend? It's a little too early to tell. But we are getting a very good indication here that we are reflating back to the upside. This could mean that 2023 could transition into a moderate upward trend, which would be similar to, say, 2003, 4, 5, 6, 7, that entire reflation rally that saw the S&P and the NASDAQ move to all-time highs. in 2007 and 8 before the global financial crisis. Does that mean that we're going to have another global financial crisis in 4 or 5 years? Well, it's kind of too tough to tell. Could be, but don't know yet. What I do know is that my custom indexes are showing that we are reflating and we are starting to move into an upward trend, whereas there's a ton of people that are still bearish, ton of people that believe this is going to tank down into the 2,700, or in this case, 270, 280 on the SPY. And my custom indexes are showing me that we are reflating again, that we've actually seen a very strong correction in the market. We've seen a very big deflation in market trend, and we are actually reflating back to the upside. Now, let me show you this cash flow index, custom cash flow index. By the way, these are now being presented on the website every week, so you can get to them on my MENT.com website and see how this is working. You can see that this is a weekly cash flow index. We had the same type of a peak here in June, July. This was a more pronounced downward trend. And you can see essentially if we look here, we've got kind of an A wave here, a B wave here, a C wave all the way down to here, and then a D wave and then an E wave. So if I were to look at this, we've got like an A, B, big C wave, extensive C wave, about 2.6, 2.75 times the A wave. And then we've got a brief correction here, and then we've got an E wave here. Now we've seen this nice recovery back up here, and I would count this as an A wave, which would indicate we'd have a B wave potential correction, could be very short, which means we could have some more weakness over the next 2 or 3 weeks before we actually settle and form a bottom. And then we will have a bigger C wave, which could potentially put us up into this 1.7, 1.8 area. Then a correction, then potentially back to new all-time highs. Now, that could be still 12, 24 months out, but we've got this breaking this previous high, which is a very good indication that we are now reflating. The market tends to move in downward Fibonacci price cycles and then eventually upward cycles and then downward cycles, eventually longer-term upward cycles and longer-term downward cycles. We have to be cautious here. We need to get above these previous COVID highs to see some real upward trending and break this resistance channel. But we are seeing a very solid reflation trade. Far too many people are ignoring the fact that underlying all of the market trends that you're seeing, we're seeing institutional traders and retail traders and global traders really start to reflate the market, reinvest in the market, putting capital to work, thinking this deeper downside move is exhausted. And when you get down to it from a standard deviation channel, we got down here just a few weeks back. I count the weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So about 3 months ago, put us back in September, we got way down here to these extreme lows, which is really these COVID lows. This is extreme market selling. This is extremely depressed price function. And now we're moving back into the I would call them the 2019 basing bottoming levels and the election period, the September, October, November 2020 basing levels right here before we saw a real reflation cycle. So at this point, finding some support over in this area and reflating into 2023 is a very strong potential. It's unless we have some sort of a major catalyst event, and when I call it a major catalyst event, I want you to think in excess of $15-20 trillion type of crisis mode. We are likely going to see U.S. stocks reflate back up into this 1.5, 1.6 area, maybe a little higher, and attempt to trend a bit higher. This could mean that we see kind of like a 2003 to 2005 reflation trade, meaning it's not going to be an excessive type of a move. It's going to be a slower reflation upward trend, but it's going to possibly move us away from the concerns of this deeper Fed move. And this could mean that global central banks move into an easing type of scenario or become less aggressive in their fight against inflation. It could mean that inflation trends are subsiding substantially. It could mean that consumers have pulled away from the speculative phase and are now reestablishing a more conservative phase. And this unwinding could take place still for many, many months, but it could be in the form of a global stock market reflation trade, kind of like 2003, 4, 5, 6. That's what I believe is actually happening. Okay, next we are going to look at, we've seen this one. Let's go back over to the chart here and let me show you kind of what's going on. So we have come from the COVID, let me come back here, from the COVID low up to the recent high. We've had an exact 50% retracement right here. This is an exact 50% low that's set up in early October of this year. Now, from that time frame, you can clearly see the A, B, C, D, E wave right down to here. Very solid downward cycle trend. Now, I do believe that this downward cycle trend is a wave 4 correction. I've been telling my clients this for many, many months, and I do believe that we are in a wave 4 correction. I do believe we've seen a full wave 5 to the downside, and I do believe we need to move back up into this area, the 4066 area on the ES or higher, to substantiate a potential wave B correction off of this low, meaning we've got to get up into this area, this range right in here, to substantiate a potential wave B correction. This would be an A wave down, B wave up, potential C wave down, which I don't believe is going to happen unless there's some sort of a crisis event. What I believe is going to happen is we are going to see this support level here off of wave 4 correction. Then if I can draw this, let me see if I can kind of give you an idea. And remember, there's all these lines out here I want you to somewhat ignore at the moment. But if I could draw what I believe is going to happen from this area, we are going to flag out sideways into early 2023. This is January, February 2023. Then we will start to move into an upward trend, come up into these areas, stall out around October, November, August, September, October, November, and then move back into an upward trend, and then stall back out, and then move into an upward trend. And around 2025, 2026, we start getting into a kind of a stalling formation and then moving potentially into a downward trend. And this could be, remember, this could be a solid wave 1 of a 5 cycle. So understand that this could turn into some sort of a upward trend that extends well into 2027, 2028. And this is where I think we're at. I think the Fed has beaten inflation. They've beaten the consumer. They've moved into a level that is substantial enough to take away the excesses. I believe the global markets have been depressed quite a bit. We still have a very strong functioning economy, and the Fed does not want to break anything. I believe we will transition over the next 6 to 12 months into a reflation trade, potentially breaching this high, this previous high, by about maybe 10 or 12%, maybe a little higher, and then move into a wave B correction here, which would then extend us even further to the upside as a wave C type of a move, potentially moving us up into the 6,000 level. And that could be where we start to reach into our critical level. Our critical time cycle analysis puts this level, the 2027-28 time frame, as a very critical time frame for the end of a broad market cycle phase. And this could be a very big end of phase move right here, moving us into a deeper downward cycle. And again, if we take a look at this from a monthly standpoint, you can see here where I've drawn. And does it look out of the ordinary to you? Or does it look like it's impossible to you to see that the global markets could reflate after all the money that's been put into the market and this moderate correction here, which is again a 50% correction from the COVID lows? So from this level here, I believe we've gone to a 50% correction. We've gone deep enough into this correction to qualify as a wave 4 correction. I believe now we're going to be looking at a wave 5 move, which could be approximately 1.5 or roughly equal to this move. So hypothetically, if we take, if we take this line, duplicate it, and drag it here, gee, look at that. Visibly, I'm drawing these almost exactly to the dime. So there's our peak level, and this would be an exact move of wave C, or somewhere approximately in that range of wave C. So hypothetically, somewhere potentially in this area could be our peak. Longer term, that could put us somewhere around the 2027, 28, 2029 area. But long and short of it, ladies and gentlemen, I believe we're reflating. I believe we have stalled out. I've shown you back over here the reflationary trade that seems to be setting up. And I believe that the U.S. markets are going to move into a decided trend in 2023. I think you're going to see the next couple of weeks be fairly volatile through the end of 2022, possibly a 6 or 7% volatility as volume is weaker. And then I think in early 2023, you're going to see an upward trend set up. I think you're going to be looking at reflation. I think you're going to be looking at central banks trying to mitigate broader risk concerns. And I think you could be looking at a series of debt, let's call them debt forgiveness scenarios. Global markets are going to continue to struggle with high interest rates, and I think that's going to push a default, a wave of defaults potentially, or IMF bailout scenarios to try to help the markets, and that's going to push the banks, the global central banks, into more of an adaptive strategy related to the damage they could be doing on a humanitarian scale and a financial scale going forward. So we're looking at really 3 to 5 years worth of reflation trades into 2027, 2028. And you need to be aware of this. This could be a very strong trend, and I don't want you to be married to the downside risk. Yes, we're still struggling. Yes, we still have some risks ahead of us, particularly over the next 4 to 12 plus weeks. But we're going to know very clearly in mid-January what we're looking at in 2023, and you need to be prepared for this reflation trade because it could come very quickly to the upside. We just need to see this stall out in this area right over here and start to move back to the upside. This would be a very strong reflation trade back to the upside, and it could see the markets really, you need to understand that we've had a roughly 35% correction in the U.S. market. We've had almost a 60% correction in some of the global markets. In order to get back up to previous high levels, that means that we would be looking at about a 45 to 60% rally in the U.S. market just to get back up to previous highs, and possibly more than 100% rally in global markets to get back up to previous highs, and we could extend beyond that. So be aware, we are at the point where we are going to potentially start moving into a very big reflation trade. Okay, my next video today is going to be about gold and silver. So follow along, follow my research, go to MENT.com, learn how I can help you, learn how my research can help you stay ahead of what's going on in the market and protect your capital. Remember, I have been safely advising my clients to move away from risks from way back in here in June, July, August of 2021. We have been avoiding risk throughout this entire downward cycle. We are still avoiding risks right now. We are effectively hedged, and if everything moves like I am suggesting, we are going to be ready to pounce and take advantage of some very big trends in the market. Okay, remember, you can't get this anywhere else except MENT.com, MENT.com. Talk to you guys later.